Welcome to our latest Tactical Asset Change update, the TAC. At Casterbridge, our approach is pragmatic, not dogmatic. We only TAC when the market winds shift. Today, I'm walking you through our first major maneuver since last September and why we identified that as the right time to move. Since then, the broadening out trade of moving away from US growth equities toward underappreciated assets has delivered very positive portfolio returns. With this positive momentum, we saw no need to change course earlier. We had actually fine-tuned several versions of this TAC since December. We were simply waiting for the right signal to act. By late February, our equity exposure was above our neutral target. We were comfortable with this until the Middle East tensions escalated. Historically, geopolitical conflict has had a limited long-term impact on risk assets. However, we felt both equity and fixed income markets had become complacent. We thought this escalation could be the catalyst for a sell-off. Following the strikes in Iran over the final weekend of February, we moved. We initiated the TAC on Monday and executed our trades on Tuesday the 3rd. Since then, markets have softened, confirming that our patience and our timing actually worked in our favor. So, how does this translate into broader positioning? While fiscal stimulus and easing monetary policy are broadly positive, geopolitical uncertainty remains high. Company earnings have been strong across most sectors, but equity valuations, particularly in the US, are elevated. With these mixed conditions, we have stayed neutral on equities. We remain underweight fixed income. Large fiscal deficits and inflation risks could lead to higher yields and falling bond prices. The diversification benefits of bonds are far less powerful now, as they are more correlated with equities than in the past. Additionally, credit spreads are very tight. Any meaningful corporate stress will cause spreads to widen, which puts downward pressure on corporate bond prices. Therefore, alternatives, such as market-neutral hedge funds, continue to play a vital role. And when bucketed together, they generate consistent returns with very low volatility and have little correlation to traditional markets. We remain overweight for those diversification benefits. To put that into perspective, in our balanced portfolio, you'll have 60% in equities, 19% in bonds, and 21% in diversified alternatives. Let's dive into some of the specific changes we've made, starting with equities. Our global AI fund, with less than 50% of the portfolio in tech stocks, has been sold. We reallocated proceeds to the Janus Henderson Global Technology Leaders Fund. While tech earnings remain strong, share prices have softened over the last 5 months, leading to more attractive valuations, which we have now capitalized on. In Asia and emerging markets, we sold our high-quality emerging markets fund to top up M&G Asia and Artemis Smart Garp EM. Both funds are performing well, but because of the underlying stocks being very cheap, we expect the momentum to continue. We increased our Jupiter Gold and Silver exposure in high-risk portfolios and also introduced it in lower-risk portfolios for the first time. We believe precious metals are undervalued and serve as a vital diversifier in portfolios right now. To fund these moves, we reduced our US mega cap exposure to move away from the high concentration risks there. Turning to fixed income, we sold our US Treasuries fund and reallocated the proceeds into 2 Royal London funds that are active in nature: their short duration global index-linked bond fund and their international government bond fund. This allows us to better manage inflation risks while taking advantage of current bond market volatility. Finally, our alternatives. We exited 1 underperforming hedge fund and introduced 2 new strategies into the portfolios: the JP Morgan Global Equity Absolute Alpha Fund and the Argonaut Absolute Return Fund. Our goal for this bucket is clear: to generate high single-digit returns with limited correlation to traditional markets. These new additions bring us much closer to that objective. Together, these changes ensure that portfolios remain well-positioned for an environment of elevated valuations, inflation uncertainty, and geopolitical tension. At Casterbridge, we maintain a capital preservation mindset. Our track record shows that we protect capital better than our peers during risk-off markets. But rest assured, we aren't only focused on the risk. We are incredibly excited about the opportunities and the major themes we are invested in. Most of you watching will be familiar with those themes, but if you are new to our portfolios or want a deeper dive into specific opportunities that we are invested in, please do get in touch. As always, we will continue to monitor markets closely, ready to tack again when the market opportunities arise. Thank you for watching.